Ladies and gentlemen, good day and welcome to Rossari Biotech Limited's earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Anup Pujari from CDR India. Thank you, and over to you, Mr. Pujari.
Thank you. Good evening, everyone, and thank you for joining us on Rossari Biotech's Q1 FY26 earnings conference call. We have with us Mr. Edward Menezes, Promoter and Executive Chairman, Mr. Sunil Chari, Promoter and Managing Director, and Mr. Ketan Sablok, Group Chief Financial Officer of the company. We would like to begin the call with opening remarks from the management, following which we'll have the forum open for a question and answer session. Before we start, I would like to point out that some statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the earnings presentation shared with you earlier. I would now like to invite Mr. Edward Menezes to make his opening remarks.
Thank you, Mr. Anup. Good evening, everyone, and thank you for joining us on our earnings conference call. It is a pleasure to have you with us today as we discuss our Q1 FY 2026 operational and financial performance. We have delivered a steady performance this quarter with top-line growth driven by healthy momentum in our HPPC and AHN segments. While the operating environment remained dynamic, our domestic business performed well, supported by demand across key categories. Our export business, however, faced some headwinds due to prevailing global uncertainties, which also impacted the agri and textile segments. Despite these challenges, overall revenue growth was healthy, and we believe that our focus on optimizing product mix and driving operational efficiencies will support a gradual improvement in profitability. Our commitment to R&D continues to drive our success, and we have seen many synergies emerge through our past acquisitions. R&D continues to be a cornerstone of our growth and innovation strategy, strengthening Rossari's position as a leading solutions provider in the specialty chemicals sector. Our R&D capabilities enable us to meet evolving market needs and offer bespoke solutions, driving growth, creating value, and enhancing our reputation for intelligent and sustainable solutions. We continue to pioneer intelligent and sustainable solutions across industries, enhancing everyday life through our eco-friendly and technology-driven offerings. Our focus on innovation and customer-centric solutions enables us to stay ahead of the industry, delivering value through products that are both high in quality and sustainability. Meanwhile, our capacity expansion projects across Rossari Biotech, Unit of Chemicals and Tristar Intermediates are progressing well, with phased commissioning expected over the coming quarters. These investments will enhance manufacturing capabilities, improve supply chain agility, and position us to serve high growth sectors. As these capacities ramp up, they will play a pivotal role in driving our next phase of growth. Looking ahead, our strategic priorities remain focused on execution, customer-led innovation, and sustainable value creation. With a strong balance sheet, robust R&D capabilities, and enhanced capacities, we are well positioned to navigate near-term challenges and deliver consistent growth while creating long-term value for all stakeholders. With this, I now invite Mr. Sunil Chari to share additional perspectives on our business performance and strategic priorities.
Thank you, Mr. Edward, and a warm namaste to everyone. Over the past 2 years, we have built a robust foundation for growth, delivering healthy volume expansion despite a challenging external environment. In Q1 FY26, this resilience was reflected in steady top-line growth, supported by traction in our HPPC and AHN segments. However, revenue growth over the past 2 years has been tempered by subdued realizations and market dynamics. With stabilizing conditions and our expanded capacities nearing commissioning, we are poised to unlock stronger operating leverage and deliver more meaningful revenue growth in the coming years. Our focus remains on strengthening the building blocks of the business, expanding our product portfolio, deepening customer relationships, and aligning our solutions with high growth applications. The strategic initiatives we have undertaken over the past few years, particularly in areas like institutional cleaning and international expansion, are diversifying our revenue base while enhancing our ability to deliver growth over the long term. Our institutional cleaning and consumer business continues to evolve as a significant opportunity. While the vertical reported a softer performance in Q1, we expect it to demonstrate healthy growth on an annual basis as we focus on scaling platforms and strengthening market presence for long-term profitability. As part of our international strategy, we are in the process of setting up an overseas formulation facility that will serve as a strategic hub for the Southeast Asian markets. The proposed facility will enable quicker turnaround times, improved delivery schedules, and tailored solutions for customers in the region. While the investment is relatively modest, it represents an important milestone in strengthening our global footprint and demonstrates our commitment to being closer to key markets, enhancing customer engagement, and building a strong platform for future growth in international markets. On the capacity front, our ongoing expansion projects across Rossari Biotech, Unitop Chemicals, and Tristar Intermediates are progressing in a phased manner. These initiatives are aimed at eliminating capacity constraints, improving supply chain agility, and strengthening our positioning across high-growth sectors. Once fully commissioned and operating at optimal utilization levels, these facilities are expected to deliver 3 to 4x asset turnover, driving operating leverage and margin expansion, particularly from financial year 2027 onwards. During Q1, as our CapEx work was in full steam and following all safety protocols, we had to shut certain production operations for 10 to 12 days intermittently due to hot work, erection, activities, etc. Hence, production was lower to that extent. We expect Q2 to be a stronger quarter. To summarize, financial year 2026 is shaping up as a year of consolidation and capability building, with our capacity expansion advancing towards completion, emerging vertical strengthening, and our international presence expanding. We are creating a strong foundation to capture the next phase of growth with enhanced scale, agility, and resilience. Thank you once again for the continued support. I now invite Ketan ji to share the financial highlights for the quarter.
Thank you, Charity, and good evening, everyone.
Excuse me, sir. We have lost the audio from your side. Ladies and gentlemen, the line for the management seems to have disconnected. Please stay connected while we reconnect the line for the management back. Ladies and gentlemen, we have the line for the management reconnected. Yes, sir. Please go ahead.
Yeah. So apologies for that. I think the line got disconnected. So I'll restart once again. So in Q1 FY26, our revenue from operations grew by 11% YOY to 543.7 crores, driven by steady performance across our HPPC and AHN verticals, despite the ongoing global headwinds. On a YOY basis, we grew both in domestic and exports, and on a Q1Q basis, while domestic was steady, the export sales were soft. EBITDA for the quarter stood at 67.9 crores, up 4.6% YOY, with an EBITDA margin of 12.5%, compared to 13.3% in the same quarter last year. The institutional and B2C business reported a loss of approximately rupees 7 crores in Q1, which impacted the consolidated margins. Excluding these verticals, our EBITDA stood at 75 crores, growing 12% YOY with an adjusted margin of about 16%, reflecting the efficiency and resilience in our core operations. As these newer verticals scale over a medium term, we expect them to turn margin accretive and contribute meaningfully to the overall expansion by FY27. On the CapEx front, our investments are progressing in a phased manner, with commissioning expected in the coming quarters. Funded through a mix of internal accruals and debt, these investments are expected to generate 3 to 4 times asset turns at optimal utilizations, driving stronger operating leverage over the medium term. Our balance sheet remains healthy with strong liquidity and conservative leverage, giving us the flexibility to pursue growth initiatives with discipline. As we move through FY26, our focus remains on executing our capacity expansion, maintaining margin stability, and building a platform for scalable and profitable growth from FY27 onwards. As we move through FY26, our priorities remain clear: execute growth initiatives with discipline, maintain margin stability, and lay the groundwork for scalable and profitable growth. With this, I end my opening address. Thank you, everybody, and I request the moderator to open the floor for questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star, then 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star, then 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Again, to register for a question, please press star, then 1. Our first question comes from the line of Rohit Nagraj from B&K Securities. Please go ahead.
Thanks for the opportunity. So first question is on the institutional cleaning business. So what has been the issue in terms of, I understand that it's a consumable business, so why on a sequential basis there is a degrowth in top line and such a sharp margin contraction? I mean, we have reported loss. So if you could just give us reasons for the same. And second associated question on the same, last quarter when we had shared our presentation, we had talked about 179 crores of revenues for FY24 and 299 crores for FY25. But if I look at the current presentation, the revenues have been 159 and 276 respectively. So is there some big statement which has happened? Thank you.
So hi Rohit, this is Ketan here. So this quarter revenues have been a little soft. I think this drop has been on especially on the institution side. Some of these orders are expected to be fulfilled over the next couple of quarters. So my submission would be to look at this business not really on a sequential quarter-on-quarter basis. It would be ideal to look at it a little on a longer term perspective, because some of the orders of the institutions are a little phased, to supply over particular months. So Q1, if you see, generally our Q1 in this business is not as strong as the subsequent quarters, especially Q3, Q4 are the stronger quarters for this business. So having said that, I think we are expecting some good traction in this business in the subsequent quarters. Q2 and Q3 specifically should be a more stronger quarter for us. And on an annualized basis, we are still very optimistic that business will keep delivering a healthy growth. And the loss, particularly in this quarter, is primarily on account of the lower sales. So while some expenses have also gone up on a YOY basis, but I think these will get evened out as subsequent quarters we report a better revenue number.
And
Rohit.
So the distinction between the numbers the last quarter and this quarter and the institutional.
What was the question exactly, Rohit?
So the last quarter, if I look at the presentation, we had given the institutional and B2C performance, FY24 revenues 179 crores and FY25 299. And when I look at the on slide number 20, the revenue number for Rossari Professional is 159 and 276. I don't know why there is a discrepancy between.
Just give me a moment.
Sure.
So the numbers which come on page number 20, Rohit, are numbers of only the institutional and consumer business. While when we report in the earlier slide, which had 299, we also include our pet care business in that. So
Okay.
The slide number 20 is numbers from the subsidiaries. So the Buzil Rossari numbers are the numbers in slide number 20. While when we report our consumer business, we also add our pet care. So the pet care business last year was roughly about that 20 odd crores.
Okay, fair enough. That explains. The second question, again, two parts. One, in terms of the institutional business, has the investment now been complete in terms of manpower and related infrastructure? And the second part of the question, last year we did, again, the entire division of pet care plus the institutional, a marginal loss. What are we looking at in FY26 in terms of whether we'll be just breaking even or we are looking at some 2-3% kind of EBITDA margin level profitability? Thank you.
Yeah. So Rohit, on terms of the investments, I think we've done most of the investment in terms of the infrastructure. Manpower, we may have a certain increase in this quarter, but in this year, but I think we are being very cautious in terms of the number of people that's going up, but it will definitely be much lower than what we had done in the last year. Last year, if you remember, we added almost 100 people in this business. This year will be substantially lower than that. On an annualized basis, we hope to break even at least on the EBITDA levels in this business, but we'll have to see how the next few quarters go. But our intention is that at least in this year, the losses should be absolutely minimal with healthy top line growth by the end of the year.
Sure. That is helpful, sir. Thanks a lot and all the best.
Thank you.
Thank you. Our next question comes from the line of Sanjesh Jain from ICICI Securities. Please go ahead.
Yeah. Good evening, sir. Thanks for taking my questions. I got a few of them. First on the UO availability now that.
Sanjesh, could you be a little louder, please? Just
is it now audible, sir?
Yes.
Okay. First question on the UO availability. Now that we are very close to commissioning the facility, we are talking of commissioning the facility next quarter. How is the UO? Are we procure the UO for the expanded capacity now?
Namaste Sanjay ji, this is Sunil Chari. The Reliance expansion is delayed and it may take few more quarters for them to start delivering higher EO. But considering the softness in the all India consumption of EO, we are able to get more EO than we were getting normally. And I think as we ramp up our capacity utilization for the new capacities, by the time we are at a good capacity utilization, Reliance EO enhancement should be ready. So we don't foresee a big issue in that in the next 4 quarters.
So you don't see an issue immediately or going forward when the.
Yeah, because we will not be able to, Sanjay ji, we will not be able to use 100% of our capacity in the first few quarters. So ramping up, will take us some time for us, and by the time, we ramp up the capacity in the next year, we should have adequate EO. That is what is our judgment.
Got it. But there's no firm commitment as of now from the Reliance side.
No, there is no. They've told us in the next year, in the second, third quarter, they should give us the, their capacity will come on stream, enhanced capacity.
Got it. My second question is on the Unitop. I was just going through the annual report, and for last year, it appears that there is a significant deterioration in the margin for the Unitop. While revenue growth was very healthy at 18%, but if I look at the gross profit margin, it has fallen from 22% to 18%, and EBITDA margin from double digit to high single digit. Now, what has happened last year in the Unitop, and what are the measures are we taking to fix them?
To give you a small background, Unitop, we acquired, it was around 300 crores. And this is a company which was existing for more than 36 years. So in 36 years, they had reached 300 crores. Now, when we reached from 300 to now, we are at an exit of nearly 70 crores, and we did 773 crores last year. This year we may practically be 3 times in 3 to 4 years. This is something where we put all Unitop products into the Rossari markets, to Rossari customers. So whatever business we got from Rossari customers would always go through Rossari. And when we do business between Unitop and Rossari, it is on a transfer pricing basis. So we should not look at Unitop, TriStar, as subsidiaries on a standalone basis. We have to look at consolidated profits of Rossari. We should not look at individual balance sheet. Is my request.
No, I appreciate that, but even if I look at on a consolidated basis, earlier we were talking of margin at around 14%. We are at 12.5%, and this is on a lower raw material prices, which means that per kg basis it has only fallen further. What explains the margin contraction on a consol basis then?
No, so Sanjay, if you see the margin on a basis shown of the consumer business, if you see our margins have again come back to that 14, 15, 16% kind of level this quarter. In fact, we were at almost 16% if we remove the consumer business loss that has come in. Last year also we were at on an annualized basis we were at about 15 odd% for the full year. So if you see, our margins have consistently improved year on year, in spite of the fact that the institutional consumer business earlier was hardly a major factor, but now with a 300 crore annual run rate of last year, it's becoming a significant portion of our overall sales.
No, I appreciate that, but again, revenue growth is also driven by the that segment itself, right? Otherwise, revenue hasn't been growing at that cliff. Now, overall EBITDA, if I look at it, we have managed to grow only 5% this year, YOY basis. So that still remain muted. I understand the challenge on the export market, but the growth appears to have significantly subdued versus what we were anticipating earlier.
I think we should, Sanjay ji, this is Chari, I think we should be happy with the fantastic performance of our B2B business. And we also have mentioned, in our comments that we had some days of stoppage intermittently for nearly 10 to 12 days at our sites for expansion. So when we do welding or when we do anything which is related to heat, we of course have to stop our production. So we lost some production that way, and that is why also you would see. But the EBITDA percentage now for the B2B business is amazingly good. I think we should be happy about this.
No, I'm happy about it. I'm just trying to understand that what has led to the slower growth. Nothing takes away from a good performance what we have delivered. Just trying to decipher to see and drive the growth from here.
If you see, Sanjay, our core business quarter on quarter has been down by about 25-30 crores compared to the Q4 of last year. I think, as Mr. Chari said, we had about a week, 10 days of intermittent closures in our facility because of the new reactors being put in. So we lost about 7 to 10 days of production, and that impacted the overall exports, where some of the planned orders we could not dispatch, and we are planning to make up for that in the second quarter. So we are expecting the second quarter run rate to be much better.
And Sanjay ji, to add to what Kiran sir said, we should compare first year of last quarter and first quarter of last year and first quarter of this year. This would be a apple to apple comparison, where we have grown 11% even in volume, sir. The volume growth has been 11%. Top line growth has been 11%, compared to last year. And even our EBITDA on the B2B side, our core business is better than first quarter of FY25. So for us, the focus is the institutional B2C and semi B2C. Yes, sir.
Got it.
Yes, Sanjay sir.
Yeah, that's clear, sir. One question on the textile side. It's been 2-3 years that we have been struggling on that segment, but if I look at the competition, Atul reported subsidiary number for last year, they have grown quite healthy, and that's been the case for last 2 years. Are we losing the market share in the textile chemical in Indian business?
Yeah, Sanjay, this is Edward here.
Hi,
so, from our point of view, the textile chemicals business is quite steady. The textile business also increased in volumes year on year, this year also. Whereas we had some value-wise, we had some export shipments which got delayed this year because of the delay in the logistics. So that got reversed because the BLs were not received. So that's the only negative, that 5-7% that got negative there. Otherwise, textile is on track. Overall, textile production in the industry was flat for the first quarter, but we are also on par with the year-on-year growth.
Got it, sir. Clear. Just one last question. How do we see revenue growth and EBITDA growth for next 2 years?
So I think, as we had said, on an annual basis, we expect to do a mid double-digit 14-15% kind of growth, both on the top line as well as on the EBITDA front. Q2 should, as I said earlier, should be a much stronger quarter for us because we'll have the agri also going out in full flow, and some of the export orders which we missed out in this quarter, I think we would be fulfilling all those sales in Q2.
So we will be holding on to the margin this year. I thought we will drive some operating leverage, right? Employee cost is largely done, and we are cutting losses in the institutional.
Sorry?
I thought EBITDA we can grow faster because we are now done with the investment in the employee cost. Our losses in the institutional business is reducing. EBITDA ideally should grow faster than the revenue, right?
Yes, it should grow, but we are still being a little cautious because pricing is still a challenge for us. Some of the raw material prices have come down, and we expect that some of that we'll have to give up in the coming quarters. So we'll just see how it plays out.
Yes, sir. Thanks all the three for answering my questions so patiently, and best of luck for the coming quarters.
Thank you.
Thank you, Sanjay ji. Yeah.
Thank you. Our next question comes from the line of Prachi from Phillip Capital. Please go ahead.
Hello. Am I audible, sir?
Yes, ma'am. Please go ahead.
Yes. Thank you for the opportunity. Sir, under the non-leo-based category, what product categories are we focusing on, and what is the market size, and what growth rate we expect going forward? Who all are the competitors and others? And in next 2-3 years, what kind of revenue contribution do we expect from this?
Namaste, this is Sunil Chari. Can you hear me clearly?
Yes.
Yeah, good. So on the non-EO side, we have mostly surfactants, and these are surfactants which include esters, which include acrylic polymers, which includes other polymers based on different monomers which we do. This also include methyl esters of vegetable oils. So these are basically, grown in a good way, even after our EO quota being nearly normally same as the last year. The competitors in this segment are basically all the similar competitors which exist, for our normal, and these are global majors which are there. And these are good companies who focus. And normally, the products we are focusing are all green chemistries. Most of these are products where there is practically zero effluent and are considered green and futuristic in nature. We expect these non-EO products which are there to go into agro, to go into home and personal care, but also this could go into oil and gas, to pharma, and to paints and coatings. These would be the primary focus.
Thank you, sir. I have one more question on the export business. So, you have said that Southeast Asia, you are opening up a smaller facility. So what kind of CapEx are we expecting in this?
So, the CapEx which is coming up in outside the formulation, it's a very small investment, about between 15 to 20 crores. And to start with, it will be a very small outgo. We'll start doing some formulation activities over there. And then as it, the business grows and we see the market acceptance, then we'll keep adding some more CapEx to that. But to start with, it's going to be a smaller one.
Okay. Thank you, sir. All the best.
Thank you. Our next question comes from the line of Pratik Oza from Systematics. Please go ahead.
Yeah, sir. Thank you for the opportunity. So can you share the EBITDA margins of our subsidiaries in this quarter?
So, Pratik, I don't think we should see the margin specifically company-wise, as Mr. Chari just spoke about it in an earlier question. It would be good to see on a consolidated level, because each of the companies, the Rossari, Unitop, Tristar, the products, there's a lot of movement of products within the companies at a transfer pricing. So ideally, it would not be really making sense for us to look at the individual company margin levels. But having said that, I think both Unitop, Tristar have a double-digit kind of EBITDA.
Okay, got it. And so another question is on the exports. I think for this quarter, exports were relatively lower sequentially. So what was the reason for that? And are things improving there?
Yeah, so this quarter, I think we could not fulfill a couple of orders we had in hand because of material availability, in light of the fact that our plant had to be intermittently closed for a few days as the new equipments were getting set up. And this being an EO-related facility, there are certain safety protocols which we need to follow. So we had to cut down on the production. I think much of those lost volumes will get done in the second quarter.
Got it, sir. Thank you. Thank you so much.
Thank you. Our next question comes from the line of Rajit Agarwal from Nilgiri Investment Managers. Please go ahead.
Good evening, sir. I have two questions, one on the export side again. So going forward, what should be the run rate? I mean, should we consider 160 crores as a quarterly run rate for this year and the next year, or will it be lower? And I'm sorry, I missed the initial part of the conversation, so if you could share the exact exports number for Q1.
So in Q1, the exports was about 139 crores. And we expect on an annualized basis exports to be around 27 to 28% of the overall turnover.
Right, sir. Thank you. And on ethylene oxide, you mentioned that the availability has improved. So are you buying from somebody else also, except Reliance? I mean, who are the other suppliers?
Reliance is the only supplier for ethylene oxide.
So they have increased their supply to you in this quarter, and they will increase going forward as well.
A little better than previously, yes.
Okay. Thank you, sir.
Thank you. Our next question comes from the line of Naresh Naikar from Systematics. Please go ahead.
Yeah, hi, sir. This is Vijay here. Hello. This is Vijay Saga here. So just wanted, sir. So just wanted to understand two broader question. One is on the overall, like once your capex comes in, we will start having the facility on stream from Q2 onward. So next year, would we be in a position to use full of that, or at least it will spill over to FY28 when we can see the full benefit of this capex flowing in? The kind of gross ton, asset ton that you're talking about, would we be able to see in FY27 or FY28?
The enhanced EO will be available mostly from September, October 2026. So I think it will be spillover, and we can see a good capacity utilization in the year FY28, and maybe, as we said, 3-4 years normally we take to ramp up to 100% capacity.
And sir, you talked about some capex on basically overseas capex that you talked about. So that is only 15 crores that you talked about, or that's a bigger thing that we are contemplating at this point of time?
No. At least to start with, as we said, that it's going to be around that number. We'll start out.
Well, it will be done.
Yes, that depending on how it shapes up, how the market is, then how logistics, etc., how it works from there, and then we if it works out well, we have plans to further expand that.
Okay, and this will be majorly, as you said, you will be doing some formulation and all that. So not full-fledged capex that you are looking, but it's a initial capex.
Yes, it's only to start with. It's a formulation setup.
Okay. And just last thing on this B2B business, at what point of time where we start breaking even, and is there some target like at 100 crore kind of sales we will be able to break even or something of that sort, or?
Yeah, so I think, as I said earlier, our target is that by the end of this year, our losses should come down substantially. We'll have to just see how the next 2 quarters go. If they go well, then we could even break even in this quarter. But definitely, by next year, we should be in a position to, break even at least on the EBITDA levels.
And this last thing, sir, this B2B, what is our kind of a target to get to in revenue mix? B2C and B2B, what is our target kind of going forward for next 2 to 3 years, where we see this B2B business going up?
So, Vijay, we don't have a target like that. We want to grow both our businesses. Definitely, the investments are happening in the B2B business. So, over the next 2 to 3 years, the B2B business will definitely grow at a much faster pace once the EO availability comes in next year, and then post that our capacities start reaching their optimum utilization. So there is no fixed ratio between how much should be B2C and how much should be B2B. Both will keep growing, and both are different businesses. They'll grow at their own pace.
Thank you. Thank you very much, sir. Thank you.
Thank you. Before we take the next question, a reminder to all the participants, if you wish to register for a question, please press star, then 1. Our next question comes from the line of Pranav Doshi from Ardeko Asset Management. Please go ahead.
Yes. Good afternoon, sir. So thank you for the opportunity. And so my first question is on the non-EU-based chemistry. So like what % of our total revenue currently or the total HPPC revenue comes from these chemistries?
We do not have, Namaste, this is Sunil Chari here. We do not have any, breakup on non-EO and EO. We don't do any breakup. There are so many products when we make formulations, there's EO and non-EO in it. So it's practically impossible for us to do the breakup in this.
Okay, sir. And like who would be our let's say major competitors in this business? Like, so you mentioned that there are a lot of global good names, but can you give let's say 1 or 2 of our competitors who are directly competing with us?
The competition is, all the global majors, who are the big global majors now, BS, Lubrizol, Ineos, Norion, Cesol, Stephen, Lamberti. So these are the big ones who are global majors everywhere in the world. These are companies which come in, but there will be some Indian companies also. Clariant is another one which has a good non-EO portfolio. Huntsman is another one. Indorama is there. So it's a combination of many companies, and even China is there. I think these are all non-EO is with all global major companies.
Okay. And sir, just YOY, even like our other expenses, they are up by around 20%. So is that mainly because of the investments in our industrial business, industrial cleaning?
Can you speak a little loudly and repeat? Sorry, we could not hear it properly.
Yeah. Yes, sir. I was saying that like YOY, our other expenses are up by around 20-21%. So is it majorly because of our investments in the institutional cleaning business?
Yeah. So if you see YOY, our other expenses have gone up by roughly about 12 crores. So I think almost 50% of this is on account of the institutional business.
Okay, sir. And so just one more question. So like given our investments in the business, so I wasn't able to understand why, did we degrow YOY and even QOQ in the Q1? Like, especially YOY.
So, you're talking about the institutional consumer business?
Yeah, the institutional business.
Yeah, so I think YOY we didn't degrow. We actually degrew quarter on quarter in terms of revenue. And I think, as I said earlier, let's not look at it on a quarter-to-quarter basis. There are certain orders, especially in the institutional front, which happen on specific periods. So on an annualized basis, we are still very optimistic. This business will deliver healthy growth compared to what we did last year, about 300 crores we've done last year. So we are still optimistic that on an annualized basis, we'll see some good growth coming in this business. A quarter could be, a little exceptional, but let's look at it on a longer term basis.
And sir, what would be our gross margins in this business, the institutional business?
What would be our
gross margins?
Gross margins are closer to the 30%, so they would range between 28 to 30%.
Okay, 20%. Yeah. Thank you, sir. Thanks, sir.
Thank you. Our next question comes from the line of Rajit Agarwal from Nilgiri Investment Managers. Please go ahead.
So one question on exports again. Could you provide the geographical breakup between, let's say, Americas and Europe and Asia?
Offhand, I may not have, but I think our large export markets are Latin America, Europe, and Southeast Asia, and we are also now doing substantial exports in the Middle Eastern bloc.
Okay. And the decline in the exports would have been across the geographies, or was it specific to one geography by any chance?
Clients.
No, the decline.
The decline.
The decline in export.
It will be across all geographies because the product availability was not there.
Right, sir. Thank you.
Thank you.
Thank you. Participants, you may press star then 1 to ask a question. Ladies and gentlemen, that was the last question. I now hand the conference over to the management for closing comments.
So thank you everyone. I hope we have been able to answer all your questions satisfactorily. Should you need any further clarifications or would like to know more about the company, please feel free to contact our team or CDR India. Thank you once again for taking the time to join us on this call. And good evening.
Thank you. On behalf of Rossari Biotech Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines.